Ready to rock?
Hi. How many of you guys paid taxes last year? How about in the last 5 years? Any of you expect to pay taxes in the next 20 years? You need to come see me. I come from Biloxi, Mississippi, and this is what happened to us after Katrina. Actually, that's my house. That's the bridge from Ocean Springs over to Biloxi, and some of my neighbors' areas. That's what happened when Katrina hit us. The only things that really made it were the condominiums. We had one that was completed in 2005 in April. It's the only thing south of the railroad tracks that basically wasn't a slab. Now it's time for us to rebuild. We lost 65,000 homes on the Gulf Coast. 15,000 short-term rentals were lost. The government cannot help us rebuild it by themselves. So what they did was they put together the Go Zone tax law, which is their way of giving an incentive to investors to come bring their money to help us rebuild our coast, something we desperately need. So whether or not you're looking for something that is a getaway for you or just an investment property, we've got it for you. The tax law is their answer, and condos are ours. Basically, the Go Zone is a very simple law. A lot of people try to make it more complicated, but it's very basic. It allows for a special bonus depreciation of 50% of the property's basis the year that it's placed in service. What this means is that if you satisfy the rules for the Go Zone, you take a property that's $650,000, you take out the land value because you can't depreciate land, that leaves you with $585,000 basis, plus you can add your closing costs and stuff like that. Then you get to depreciate $292,500 off of your taxable income. That means if you're in a 35% tax bracket, the net check that you don't write the IRS or that you get back that you've already written to the IRS is $102,375. Does that make a difference for anybody? Would you rather keep your tax money and go buy a condo that you get to have your name on, or would you rather support some woman with 10 kids and no job? Okay, this equates to 15.75% of the price of anything that you buy in the Go Zone. If you're in a 35% tax bracket, God forbid you're in a higher one, it just makes you that much more. Basically, you can pay with it or play with it. It's your tax money. Any net operating loss that this creates on your taxes can be carried back 5 years or forward 20. This is a 25-year possible use that you can derive from buying investment rentals in the Go Zone. The location is Baldwin County, Alabama, west through Louisiana. Basically, that is, the border of Florida and Alabama on the Gulf, west. The purpose for what we sell, basically the only kinds of property that will qualify are residential rental properties or non-residential commercial properties. Second homes don't count, primary residences don't count. They figure you're coming anyway. But they do want to bring investor money into the area that wouldn't otherwise be there, so you're the guys that get the tax break. Okay, these are the rules, and they are very simple. You must have purchased the property after August 27th, 2005. The property cannot have had any sort of a binding contract written on it before August 28th, 2005. The property must be placed in service in the active conduct of your trade or business before 2011. We got an extension. It used to be through the end of 2008. Now it's through the end of 2010. So it has to be before 2011. The IRS has interpreted the active trade or business requirement to be satisfied when the taxpayer meaningfully participates in the management of that property. Now, meaningful participation is a very unfortunate choice of words because to go from passive to active income, you have to have material involvement, and they sound very similar. But meaningful participation has been defined by the IRS as a taxpayer buys a restaurant. He hires a manager to operate that restaurant. That manager does the hiring, the firing, the budgets, everything. But he meets with that manager 4 times a year. That satisfies meaningful participation. So it's not like it's a tough one to satisfy. You buy a condo, slap it on a rental program, and talk to your manager 4 times a year, you're good. The go zone no-nos. You cannot buy a piece of property in the go zone for the tax depreciation with 1031 tax-deferred exchange money. Not that you'd want to, because the whole concept is to have a large basis to depreciate, not roll a lower one in. The property may not have been acquired from your mother, brother, sister, cousin. And remember, we're in the South, so that's kind of important to us. It cannot be a property that's used in connection with either a casino or a golf club or something of that nature. It's got to be really a true condominium. The most confusing caveat that we've seen with this goes on, the one that everybody loves to argue about. Of course, you can put attorneys in a room and they'll argue about anything, but this one has been fun. The original use of the property must begin with you after August 27, 2005. A lot of the accountants and attorneys that love to argue have moved the period and moved it to must begin with you. So there's been a lot of confusion about whether or not it has to be a brand new property or if it can be a used property. We have a letter from the IRS that we got about 2 years ago that states that as long as it hasn't been used for the go zone depreciation, it would qualify. So that is a little bit ambiguous the way they've worded it, so I recommend that you get somebody who you feel comfortable listening to the advice of, but that is the most confusing caveat. Now, if the property qualifies and the way that you purchase it qualifies, there are still other issues that people have to pay attention to with regards to how it works for you. I can tell you that the properties that I will show you qualify. How it qualifies for you with active versus passive income is very different. It depends on how you file your taxes. If you are a real estate agent or in the real estate business and that is your primary source of income, this comes off your active income. If you're married to somebody and you file joint tax returns who is in the real estate business in any way, shape, or form, it comes off your active income. If you are not, if you're a doctor and you don't have a wife or husband that's in the real estate business, there are other things you must do in order to use it against your active income. Or if you have a lot of passive income, you might want to keep it passive. So if there's a 500-hour rule with regards to management, there's a lot of things that you can do in order to switch it from passive to active income, but we'd have to talk about that another time. I don't really have time tonight. I got a little ahead of myself, sorry. All right, we are not Deliverance in Mississippi. Just so you know, we have teeth. We're pretty normal folks. It is it's a baby Vegas, but we are going to college now. We're growing up. It's quite wonderful down there, actually, and it's beautiful. It's a real city. It is the #2 gaming destination in the U.S. now. It's getting very big, very quick. We've got all the big boys from Vegas down there building or already having built casinos. It's really taking off. Some of the largest corporations in the world are investing heavily in our area. Gaming has brought in all the big boys. The insurance money is making sure that all the new properties or all the devastated properties come back brand new, giving the Mississippi Gulf Coast a total facelift, forced albeit, but it is a facelift. Tourism is back already and rapidly growing. New developers need to be building as much as possible because we have a huge demand and no quantity. And the tax law, of course, has just made it that much more exciting for people to buy. In January, actually December of last year, we had reached 25% above our pre-storm gaming revenue. That was with 10 of the 12 casinos reopened. We lost 12 in the storm. We had 12 before the storm. 10 reopened, and we were already